With SOFI's management being so consistently conservative with their guidance despite their strong execution, that has actually led some investors feeling pretty let down by management after their most recent Q4 earnings. Now, on the face of it actually seems quite justified, because when you take a look at the stock price, you can actually find that, since its Q4 earnings, SOFI stock finds itself down nearly 15%. And on top of that, actually, their 2025 guidance came in a little bit softer than expected. And so even though they kept their 2026 EPS guidance the same, because of the discrepancy between where they are in 2025 and what they hope to achieve in 2026, many investors remain skeptical. But I do believe that is actually missing the point. Now, I'm in no way a SOFI permabull or anything like that. I'm just trying to be as objective as I can and to bring some perspective to the entire situation, because I can't say that I fully agree or understand management's approach to guidance as well. So I do find myself a little bit frustrated. But at the same time, to say that this is a shit company, this is a crap company, is basically throwing the baby out with the bathwater. Because when you look at the numbers, as we are going to do in this video, what you actually realize is that this is perhaps one of SOFI's best quarter, and what it actually shows is that we might be at an inflection point for their business, which is why it is actually even more important for us to understand the key metrics to pay attention to understand SOFI's changing business. And as investors, it is our responsibility to assess how management actually wants to run their business, to determine whether or not there is still potential for them to sustain their growth going forward, and whether we want to be a part of that growth story. But as always, potential is a dangerous word, so let's dive in. I just want to start by saying that I do understand the frustration, and I'm not here to try and defend the company. You can do whatever you want with your position. It's your money at the end of the day, and it is your decision. But at the end of this video, I'm going to be taking you through my own thought process regarding my portfolio allocation for SOFI and lay out exactly what I'm looking for in the months ahead. You see, this is one of those videos where I find myself sitting in front of my script not sure where to start, because there are so many ways to tell this story and I want to be as objective as possible. And I guess this is why they say hindsight is 2020, because looking back at my own earnings projection video, I think I really made a mistake, and it could be summed up in this one slide that you see over here. Now, I was actually swayed ultimately by the narrative around the company. And if you want to know, in a little bit more detail what I mean when I say that, I'll link my previous video over here. And in that video, basically, I will go through a whole explanation of why I don't think the PSUs are going to be affecting how management executes going forward. But my mistake in this particular earnings video that I'm referring to right now is that I was expecting SOFI to be conservative in terms of their execution and strong in their projection going forward, when usually if I were to look at the trend and based on evidence of the past, they are basically strong in their execution and conservative in terms of their projections. And so when I was predicting SOFI's earnings, right, I found myself being caught in between my head and my heart over here. I felt that their lending revenue could come in at $417 million, and this was my initial projection. And this was actually very, very close to the actual lending revenue of $422 million. And so if you take a look at the numbers, SOFI actually ended up doing $207 of lending revenue per member in Q3 of 2024. And I basically just simply expected this momentum to continue all the way through to Q4, which is how I ended up using $205 of lending revenue per member as my initial projection, and that is what got me to lending revenue estimation of $417 million. Now, at the end of the day, I decided to convince myself to lower this expectation heading into earnings, and the reason for that was because of the PSUs. That was just playing at the back of my mind, and I was just trying to second guess how management will actually play the upcoming earnings to set themselves up to achieve their PSUs in the year ahead. But if I were to completely disregard the PSUs, purely looking at the numbers, I think my assumptions were well within expectations. And true enough, lending revenue, like I said earlier, came in at $422 million. And if you do the math, that actually amounted up to a lending revenue per member of $210.34, just above their Q3 numbers. But with that, I think it's important for us to start with, at least for me, what I consider to be one of the most important metrics in understanding SOFI's business, and that is their member growth. Now, on the 12th of December 2024, SOFI actually reached the 10 million member mark. And if you do the math up to that point in time, from the start of Q4 up to that point in time, they basically added 8,600 new members every single day. So if you extrapolate that out to the end of December, that would mean SOFI would have added in the ballpark of 780,000 new members throughout the whole of the fourth quarter of 2024. So on a non-adjusted basis, the new members added onto SOFI platform actually came in at 785,000 new members, which was fairly consistent with what we were calculating. Of course, on my end, with my own expectations, I was a little bit more bullish, expecting 800,000 new members added, but we are really not too far off. And so when you net off all the inactive members, the net member growth was around 754,000 new members. Now, in terms of products, that basically came in at 14.74 million versus what I expected, which is 14.85 million products. Now, at the end of the day, this basically puts our total products per member at 1.46, which is consistent with what we have seen in the last 3 quarters. Now, if you take a look at 2025 guidance, and this is where I start to have a little bit of problem and where I find a little bit of a disconnect with what SOFI is guiding for and the actual numbers. They guided for members added in 2025 to be 2.8 million members, and that assumes around 700,000 new members added per quarter. Now, after spending so much money on marketing through various sporting events like the NBA and the TGL, and with the addition of the new pool of members that they have access to through their loan platform business, and having grown members comfortably above the 700,000 mark per quarter for the last 2 quarters, to be only guiding for 700,000 members added per quarter in 2025, even on an adjusted basis, seems overly conservative to me and doesn't match their goals of trying to expand their revenue, trying to grow their revenue. So on an adjusted basis, I would at the very least expect them to add around 720 to 750,000 members per quarter. Of course, there might be some seasonality in that number, and we may not see that in the first quarter of 2025. But on an unadjusted basis, I still hold them to their previous expectations of growing anywhere between 800,000 to 1 million members per quarter. And so my expectation was actually for SOFI to guide this number closer to a 3 to 3.1 million members added over the course of the whole year, and to actually beat that number. Because from where I'm looking at the business, I actually see 3 major tailwinds. Like I said, firstly, marketing through all these sporting events. Secondly, the loan platform business, allowing them to onboard members who are outside of their usual credit box into their other products. And finally, as they start to incorporate crypto back onto the platform, I do believe that they will see an inflow of new members. But the only thing to note over here, this tailwind that I'm talking about, this crypto tailwind, is not necessarily a given because we don't know the timeline of that happening. And by the time regulations actually permit them to offer crypto once again, we might actually find ourselves in a crypto winter. But this is definitely something for us to consider, and I'll talk a little bit more about what management says about this later on in this video. So first and foremost, I call BS on their member growth numbers, but secondly, I also join the dots with what management has said previously, right? Which is that this year, they're expanding their focus, and they're not just planning to generate revenue by onboarding new members. They're actually also planning to generate revenue by monetizing existing members through product adoption, which means that I will expect 2 things going into 2025. Firstly, member growth should still be above 30% year over year, which is actually already considered a slowdown from where they were at the start of this year, but I can accept that if the products per member increases past the 1.5 products per member mark. And I'll show you what that means for valuation in another video. Now, looking ahead at lending, my own expectations for lending were way off in a very good way. Now, I'm not going to repeat whatever I've mentioned earlier, but basically I lowered my initial prediction of lending from $417 million down to $398 million. So I was off by quite a bit. But what I really want to point out is that in terms of loan originations for SOFI, that came in at $7.2 billion, which is up 66% year over year. And this translated to $708 of originations per member, which continues the upward trajectory, hopefully back to the $800 range. Now, if you look at SOFI's full year lending revenue, that came in at $1.48 billion versus the $1.33 billion a year ago. This actually represented a 10% year over year growth after guiding for lending to come in at 95% of 2023 levels. And so I believe this bump in Q4 lending revenue is also helped by nearly $1 billion in whole loan sales at a blended execution of 105.5%. which basically shows there is strong demand for SOFI's loans, and this basically proves whatever management said is true, right? They have told us previously that the loan platform business isn't cannibalistic of their whole loan sales, and they have basically proved that in this most recent quarter. Now, during the earnings call, Chris Lapointe basically told us that SOFI aims to grow their lending business in the low double digit to mid-teens, and this is going to be compounded all the way through to 2026. And so if you consider for a while with me that they actually guided for their lending revenue in 2024 to come in at 95% of 2023 levels, and in the end came in at 10% year-over-year growth, I don't think it's too far-fetched to assume that they can easily hit a 20% year-over-year growth for their lending platform, at least high teens going forward. So especially in the first 2 quarters of 2025, where they're actually comparing with the first and second quarter of 2024, to me those seem like pretty easy comps. But let me do a little math for you to show you what I mean. Because if I were to assume a 20% year-over-year growth in lending in the first quarter of 2025, even with SOFI's guidance of 700,000 new members added in that particular quarter, that would actually result in a decline of lending revenue per member down to $171. This is a drastic decline, not just on a quarter-over-quarter basis, but on a year-over-year basis. So once again, the math is telling me that they will easily beat their lending expectations, and the only question is once again, how aggressive will SOFI be in the year ahead? And I hope they continue the trend of increasing originations per member back to the $800 range, and lending revenue per member to stay consistent at least in the low to mid $200 range. Now, when it comes to their financial services segment, I was pretty much spot on. I basically expected an 84% year-over-year growth, and that is exactly what we got, and this was driven by a strong loan platform business. Now, my expectations for financial services revenue was $256.35 million, and the actual financial services revenue was $256.52 million. So we are literally off by $170,000. We are actually off by 0.0006%. But what I really want to focus on is the growth of their loan platform business, because I think in one of my earlier videos, which I will link over here and down in the description below, I argued that despite of the lack of growth of their tech platform, if they are able to scale this fee-based revenue, this could be another path for them to achieve a hybrid multiple, because they're no longer going to be constrained by their balance sheet. And if you take a look at the performance of the loan platform business in this most recent quarter, they originated $1.1 billion in loan originations through the loan platform business, and this basically generated for them $63.2 million in loan platform fee. So this is basically counted under financial services revenue, and the $3.6 million in servicing cash flow is basically counted under lending revenue. But if you were to just focus on the fee that is generated, this is around a 5.7% fee, but more importantly is its impact on contribution margin. Now, in the previous quarter, when the loan platform business was just launched, I basically assumed that they would have similar margins to lending revenue between 50 to 60%, and this time we actually got confirmation of this from Anthony Noto himself. He told us that margins of this business is north of 50%, and this is important for investors to know, because the 45% contribution margin that we are seeing in the financial services segment is largely driven by the loan platform business, and I don't see why this can't be operating at a 50% contribution margins once they have it running for a full year, especially since we already know that they have signed partnership with Fortress and Blue Owls totaling $7 billion, of which $3 billion could very easily be originated in 2025. This is actually pretty crazy, because all of this is just within one segment of the financial services itself, and the financial services comprises of many different businesses. So throughout the whole call, I think the whole theme that SOFI's management is driving towards is monetization and reinvestment into the business. And SOFI actually plans to do this by scaling their invest business, as well as incorporating a $9.99 a month subscription for people who do not have direct deposits set up with SOFI. This allows all these people to enjoy the perks of being a SOFI Plus member, and that itself drives product adoption, because we know that a SOFI Plus member is more likely to take on more than one product, and this fits in nicely with the objective of wanting to drive more revenue growth by effectively monetizing their member base, which means that they're not just going after member growth, but quality member growth, which to me is defined by a member who is likely to use more than one SOFI product. So this is an effective way for them to push revenue growth on a per member basis. And if we are looking ahead to 2025, SOFI has actually guided for financial services revenue to be growing at between 60 to 65%. Now, with the current revenue per member standing at around $20 of revenue per member, a 60% year-over-year growth here puts this number at $32 of financial services revenue generated per member. And that is where we want to see them trend towards throughout the entire year. But that's not all, because there's something else we need to understand to tie all of this together. But before that, we need to talk about the tech platform. Now, in terms of the tech platform, I expected the number of Galileo accounts to come in at around 164 million and revenue to come in at $108 million. But in the fourth quarter of this year, SOFI's Galileo accounts basically grew faster than I expected, coming in at 168 million accounts, and revenue only came in at $103 million, which is a 6% year-over-year growth. Now, I was saying previously that I didn't expect the tech platform revenue to reach a single-digit growth, but obviously I was wrong. So looking ahead, SOFI is actually guiding for low to mid-teens growth in their tech platform for 2025, but at this point in time, I'm inclined not to take their word for it and assume a mid to high single-digit growth seems to be more likely at this point in time. So if you ask me what I actually think about the tech platform, I do think that it's frustrating that management consistently gives guidance and misses, because to me it shows that they don't necessarily have a good grasp on the business itself. And I've said this in the past, and I still believe that this is true to some extent, that the majority of SOFI's board may be exceptional in navigating the finance industry, but they might not have the experience or the ability to effectively scale a tech platform. So to me, this tech platform revenue number meant that on a per account basis, the tech platform revenue fell to 61 cents, and that is very, very disappointing for me. I think I know a lot of you down in the comments below have been telling me about what a long sales cycle this can be, which I agree to some extent, and I can see your point of view. In fact, SOFI actually confirmed this in the most recent earnings call, right? But I have my reasons for my frustration, which I will explain in detail later on, and you can let me know what you think down below. On the call, SOFI actually spoke about a large US-based financial services provider who will eventually become one of their top 10 clients on a revenue basis. And so this is actually a significant client for them, but once again, you can see over here that the entire transition process takes over a year, which stands to reason that any significant deals on their tech platform that they sign even in 2025 will not have a significant impact to their revenue number until the second half of 2026 at the earliest. And the tech platform revenue will only play a small role in 2025 and 2026 projections. But here is the problem that I have. You see, I understand the whole dynamics of how some of these larger financial institutions do not want to use SOFI's products because they perhaps view SOFI as a competitor. I also understand the budget concerns that they have due to the uncertain macro environments. But my question has always been, if you believe what you have is the AWS of fintech, why are you not pushing it even more? And if what you have really is the AWS of fintech, why does it seem so easy for these big financial institutions to choose not to work with you? Because, yes, we might be in a tough macro environment, but we don't see companies cutting back on AWS and stop working with Amazon. So I want to cite two examples over here of why I think SOFI's management really need help to scale their tech platform business. Now, when Amazon first launched AWS, there was skepticism among the larger enterprises, which is exactly what we are seeing with SOFI's tech platform today, because all these large enterprises were worried about security concerns and the lack of control when it came to cloud computing. And so the initial adoption of all these cloud computing and of AWS was primarily among startups like Dropbox and Netflix at that point in time. And I think we see the same model with Palantir, where they go after multiple smaller contracts, and over time through AIP, they managed to demonstrate their capability and scale their businesses into what we see today. So on top of that, I also do wish sometimes that Anthony Noto comes across more like an Alex Karp type figure, because Alex Karp is the kind that will go out and say that, you don't like us, but you have no choice, you have to work with us. And I do feel that if what SOFI has really is the AWS of fintech, I would like to see management be more confident about their product. Because if you remember, I pointed out that back in 2023, basically SOFI's management took the decision to change their strategy regarding the tech platform and focus on acquiring larger customers instead of smaller smaller deals. And the whole reasoning behind it is because they want the tech platform to generate sustainable revenue. Now, on the surface, that seemed like a fantastic idea. But as we have seen from companies like Amazon and Palantir, this isn't how technology is usually being scaled. And this is where I say, the finance background that SOFI has is really holding them back. I think they are looking at this problem from a cash flow perspective, and they miss the opportunity of basically scaling their businesses through all these smaller fintechs that use their products. Because SOFI alone cannot convince the large financial institutions that they need SOFI's Galileo product. But if a bunch of other fintechs are using SOFI's products and out-competing the big banks in various fronts, you basically light a fire under the asses of all these big financial institutions. And at that point in time, SOFI doesn't need to convince them anymore. They will come and want to buy the product from SOFI themselves. And from that perspective, I do think that their strategy regarding the tech platform is not the best. And until and unless they get someone else in to assist Derek White in scaling this platform, I think the dream of SOFI having the AWS of fintech is a 2028 and beyond dream. And the most we can expect from them until then is that this is just a vertically integrated tech platform that saves costs for them and perhaps generates a small portion of their revenue. And if you ask me what metric I'm looking at, particularly when it comes to the tech platform, it is actually the growth in Galileo accounts. You see, the reason why I'm more interested in the pace of account growth rather than revenue is because we know that revenue will only be recognized about 1 year after they onboard a new client. And so the pace of growth of Galileo accounts is basically reflective of future cash flows or future revenues for SOFI. And apart from the typical numbers that we were talking about, I think there are two things in particular during the earnings call which I picked up that excited me about SOFI. You see, if you ask me, I think truthfully, I don't think SOFI will get a hybrid multiple because of their tech platform anytime soon. And for me, that is perfectly fine because I think the potential for their loan platform business to grow is what can actually give them the hybrid multiple that they are looking for. So Anthony Noto, during this most recent earnings call, basically gave us a glimpse into what is possible with the loan platform business. Right, he actually says that he's not opposed to moving SOFI's entire lending business onto the loan platform, and that would actually create a high margin, low risk business that is highly scalable and that would command a higher multiple at the same time. Now, on top of that, I believe SOFI's management is looking to move aggressively to incorporate crypto back onto their platform as soon as regulation allows, and that is additive to their financial services revenue as well as strengthening their overall financial services flywheel, because crypto was initially a big part of their SOFI Invest offering. And therefore, I think that going into 2025, SOFI's strategy has somewhat shifted. Profitability is taking a back seat and the focus is now on monetization and reinvestment. SOFI's management sees opportunities for growth in untapped addressable market, both within and outside of their current offering, which they plan to go after. And I think we have heard from management previously, and Chris Lapointe actually mentioned this again during the UBS Fireside Chat, that they haven't fully monetized their existing customer base. So he gave the example of how in the home loan side of the business, actually only 2% of current members actually use them for their home loans. And now we're hearing the same thing when it comes to the monetization of their financial services product. And I think we can see pretty clearly that SOFI is actually very confident that their investments into these different growth drivers will see a rather quick payoff, because they're actually now saying that they expect to exceed previous guidance of 20 to 25% revenue growth through to 2026. And to put it simply, they're basically making a trade-off for profitability to go after growth. You see, SOFI are currently operating at an incremental margin of around 40%, and what the management is doing is trying to reduce this number down to 30% so that they can have extra cash to reinvest back into the business. Now, many people may actually question, why are they not just focusing on profitability? And this is where we do need to take a step back and realize that, it's not true. SOFI is not cutting back on profitability, but what they're doing is that they are actually reverting back to their original business model, which has them operating at a 30% adjusted EBITDA margin. And they were operating above this level just to drive profitability in 2024. But over a longer period, it didn't make sense to be operating above their 30% adjusted EBITDA margin target, because that would mean sacrificing the ability to scale their business and gain market share. And ultimately, to me, what is important is that they reiterated their 2026 EPS guidance of 55 cents to 80 cents with a 20 to 25% EPS growth beyond 2026. SOFI currently makes up around 80% of my portfolio. Now, I usually don't allow a position to take up such a sizable part of my portfolio, but if I'm honest with myself, the reason why I have allowed this to grow to become such a large part of my portfolio and kept adding to the position is because of the timelines of the PSUs. I wanted to align myself with SOFI's management's incentive. But since management has shown me that their focus here is not on the short-term incentive but on creating longer-term shareholder value, then I wouldn't mind reallocating part of the capital at this point in time. However, with that said, I don't actually see any urgent need to do that right now because everything I believe about SOFI is still true. I believe that they are being misunderstood by the market and they are still being underpriced. And the only thing is that the other companies in my portfolio are showing equally strong execution and I would like to add to them. And so previously, I think the thinking over here is that the management was trying to reach their PSUs, and because of that, I'm less inclined to take some profits and redeploy the capital. Because you see, I actually bought this company all the way back when it was $14 to $15 a couple of years ago, and I bought it all the way down to the $4 range and all the way back up again. So it does make sense for me to start to take some off the top and not be too greedy over here. And so the plan is perhaps to sell some covered calls at slightly lower strikes than what I've been doing, and not to be too worried if a small portion of this position is eventually called away. I'll take it as, forcing myself to lock in profits and giving myself the opportunity to balance my portfolio. But even then, I still see SOFI as being a major part of my portfolio, at least 50% of the portfolio for now, until the end of 2025, and then we'll reassess at the end of the year. And that is largely down to how I view SOFI's valuation, and I talk about how their change in strategy will actually affect their valuation in this video over here, and I'll see you in the next one.